Friends, this is Vikas Mani and I welcome you all on this channel ONR Studies Circle. Friends, we are in the series of ratio analysis and in this video we are going to cover some ratios of solvency. That means we are going to talk about solvency's ratios. And out of solvency's ratio, we are going to discuss about interest coverage ratio, debt service ratio, capital gearing ratios and ratios based on return, such as return on equity, return on preference share, return on capital employed, so on and so forth. But before we explaining these ratios, first we have to have a firm grip and understanding about income statement, and we have already made a video on it. So before you watch this video, I request you to watch that video in order to understand the mechanism of income statement, and you may see the link in the description. Before starting this video, I request you to like this video and subscribe this channel if you really would like our efforts. So let's start to understand these ratios. The first ratio is capital gearing ratio. Capital gearing ratio in business, for example, if you drive a car at a very fast speed, so certainly you will reach to your destination in a very less time, but the risk of accident would be so high. On the another side, if you drive a car at a very slow speed, the chances of accident, the chances of injuries would be very less, but at the same time, to reach to your destination would take a lot of time. The same concept applies in this ratio, capital gearing ratio. In business, we have some sort of capital in which we have to pay the fixed percentage of amount, whether we earn a profit or not. But there are some other capital in which the amount depends upon the profit. If there is a profit, then we have to pay the amount. If there is no profit, then there is no obligation to pay the amount. So we need to check whether are we running very fast or whether are we running very slow, or are we into a moderate situation. So what type of capital in which we have to pay a fixed percentage of interest? Those capital are debentures and preference share. Preference shares has a nature in which we have to pay a fixed percentage of return, and in the case of debenture, same concept applies here. But in case of equity, it depends upon the profit. Equity shareholders in general manner do not have any fixed percentage of return. Whenever there is a profit, if profit is high, their return will be high. If profit is low, their return will be low. So that means as per the business situation, their profit will fluctuate. So we will compare how much amount business has to pay whether there is a profit or not. So if we are getting very less profit, but if we have to pay a lot of amount at a fixed percentage, so this is going to be a very dangerous sign. So these kind of indicators we are going to analyze using this ratio, and the formula of this ratio is debenture plus preference shares divided by equity shareholder fund. The fund particularly belongs to equity shareholders. A formula is created like this because actually this ratio tells us how much money we have to pay whether we earn a profit or not. So this type of indicator is to be checked by using this ratio, capital gearing ratio, on what gearing mode we are running our business. If there are a very growth business opportunities, then of course some sort of extra risk can be taken. But if we are in danger, then we have to be in a moderate situation. So these type of indicators can be seen by using this ratio. Interest coverage ratio, what actually it tells us? For example, if we have a limited amount of money as a shareholder, but in business there are very high growth opportunities, so there is no harm to take loan and use that money in order to earn more profit. So that means if we take a loan, then of course we need to ensure that the profit is so high. How much in multiple we have earned as compared to the interest we have paid. This is what is to be seen by using this ratio. How we do it? profit before interest, tax and dividend. That means once we reduce up all the direct expenses, all the indirect expenses and overheads, we have the profit, the net profit, in which we have not paid interest, we have not paid taxes, we have not paid distributed even dividend. So there is a particular profit and we will use that profit because the interest has not yet been deducted out of that profit. Profit before interest, tax and dividend divided by the amount of interest, and we will see how much profit in multiple we are earning as compared to the interest we have paid. So this is why profit before interest, taxes and dividend divided by the amount of interest. Another ratio we are going to talk about is debt service ratio. As its name says, debt service ratio, we have taken a loan and we only not need to pay the interest, but in future we have to pay the principal amount as well. So how much benefit in nutshell we are getting based on the loan we have received and you are using in our business. So in order to check this concept, we need to use this ratio, debt service ratio, how the particular debt is serving profit to our business. Debt service ratio, the formula is profit after taxes plus interest divided by the amount of interest plus the principal amount of loan. Why it is like this? Let us understand. Profit after tax, first of all we earn a profit, thereafter we have paid interest, thereafter we have repaid taxes as well. Then we have profits for dividend and equity shareholders. So profit after taxes, that means profit after taxes. Out of that profit, of course, we have some obligations in near future to pay the principal amount as well. So we will pick profit after taxes because we have paid interest, because we have paid taxes. The another reason is because the principal amount of loan is not to be treated as an expense. So we have to pay the taxes right after interest. So we will pick profit after taxes. But we are going to add, in order to analyze the debt service ratio, we will add interest, because principal amount plus interest. In loan we are not only paying the principal amount but also we are going to pay the interest. So if there is the interest in dividing factor, of course we will add interest in profit after tax as well, because we have paid interest and that interest belongs to that loan as well. So profit after taxes, out of which we will pay the principal amount, but interest is also a part of loan. So profit after taxes plus interest divided by principal amount of loan plus the interest. Now let us talk about returns, ratios based on returns. First of all, we need to understand two things: the parts of profit, the types of profit, as well as the capital structure. Profit, we earn profit after reducing all direct and indirect expenses, and we pay interest, we pay taxes, we pay dividend to preference share, we pay dividend to equity. So for example, if our profit is 2 lakh rupees, we have paid interest 20,000, we have paid taxes 40,000, and we have paid dividend to preference shares 60,000, and remaining balance will be shifted to equity shareholders. So if we want to understand the ratios based on return, now we need to understand the capital structure. How capital structure in any kind of business is being formed. First of all, equity shareholders, they invest in their money into the business, minus fictitious assets plus their reserves. The reserve belongs to equity shareholder, not to preference shareholder. The reason is because preference share will get a fixed percentage of return. So even if there are very high opportunities to grow in business, why would they invest? Because whether there is a loss or profit, they will get a fixed percentage of return. So they have no interest in order to make reserve. So But in case of equity, whenever profit is high, their return will be higher. So they will have an interest to make some reserve in order to make sure that they will enjoy a benefit for future possibilities. So reserve will belong to equity shareholder. Equity shareholder minus fictitious assets plus reserve. If we sum up all these, it will become equity fund. Once we add preference shareholder fund, it will become equity, the total strength of shareholders. And thereafter we will add debenture plus loans. So if we sum up all this, it will become capital employed. So now we understand, in capital employed, it not only covers the amount of shareholder, but also it does cover the amount of loan. That means when we talk about interest as its part, when we talk about dividend, it has its part. So when we want to check the profit, it is a total amount of profit we will need to pick. The reason is because we are picking up the total capital, not only the capital of shareholder, not only the capital of loan. So we are going to pick the total capital. So we will also pick the total profit. So total profit, because profit divided further in interest, taxes, preference dividend and equity dividend and their parts. So we will pick total profit. The total profit would be profit before interest, before taxes, before dividend. Profit before interest, tax and dividend divided by capital employed. Return on capital employed, the formula would be like profit before interest, taxes and dividend divided by total capital employed. Now we should talk about return on equity. Out of profit, the amount enjoyed by equity shareholders after reducing interest, taxes, we have paid some amount to preference dividend, the amount left is a part of profit for equity shareholders. So when we want to talk about return on equity, we will pick that particular profit and we will divide the amount, the value of equity shareholder fund. And for instance, if we want to check about return on preference shareholder, so we have paid a particular amount to preference shareholder out of profit. We will pick that profit divided by the preference shareholder value. So that's how we will calculate the returns. So see you in next video. Till then, goodbye and take care.